Welcome back to another Zero DTE podcast, and today we're on Season 2, Episode 26, where Ernie talks about controlling your exposure, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description to Ernie's course, and I hope you enjoy, guys.
Alright, first faux pas of the day. Need extra strong coffee for this one. Death Wish coffee. That's okay, because I have unlimited energy. So what we're going to talk about is how you determine your exposure or your position size in a zero DTE trade. Now, we trade a number of different assets with zero DTE, but they're all based around market indexes. And the primary ones that we do are the SPX, which is obviously the index to the S&P, the NDX, which is the index to the NASDAQ, and we also do the XSP, which is a micro version of the SPX, and also the E-mini S&P futures, which is a futures version of the index. And the reason why we trade those three different S&P variants is because essentially there's a couple of reasons, but basically it's because of size. The SPX being the biggest one, carrying the largest margin, and then the E-mini S&P futures about half the size of the SPX, and then the micro about 1/10 the size of the SPX. We trade the NDX, which is the NASDAQ index, and we trade that mostly because of its incredible volatility. It's a bigger size, so we can get much bigger trades on it, and also we're able to push them much further out of the money, so we can get that really primo risk to reward that we're often looking for. So those are the things that we trade, and then and their relative sizes. And so they give us a wide range of ability to create exposure to the market. Now, there are a whole bunch of other factors that we have to take into consideration. Now, of course, the most important factor is our own personal capacity and tolerance for risk. How big is our account size? How much are we willing to wager each day? Now, we still want to make sure that we maintain our primary strategy, and that is to have asymmetric trades on, trades that have extreme asymmetry, extreme risk to reward, because there's incredible benefit. And of course, our primary strategy is to collect premium on the zero DTE event for S&P options. And that's because on the zero DTE event, we have the smallest window of time where we're going to collect the maximum rate of premium. So we combine the asymmetry with a premium collection, and now we have a real winner. Our third, I guess you could say the third stool to this, or third pillar to all of this, is our process. Now, our process has to include our strategy and our day-to-day process, how we log and journal trades, etc., and our continuous improvement process. And then the situational strategies that we come up to. So our first consideration, obviously, is how do we get into the market? Now, surprisingly, getting into the market with zero DTE trades is relatively simple. The way we get into the market is we simply set up a butterfly strategy, an out-of-the-money butterfly strategy. We push it way out of the money so that we can get the kind of risk to reward that we're looking at. Remember, I said a minimum of 1 to 9, and there is no compunction of going to, say, 1 to 10, 1 to 15, or even 1 to 20. That all really depends on the amount of volatility there is in the market. So if it's extremely volatile, we'll want to push it a little further out. And also, we might even want to go wider. Now, we could do this with any of these indexes. We could choose the SPX, the NDX, the XSP, or the E-mini futures. So there's this sort of almost not infinite, but there's just this incredible range of exposure that we can have every single day. Now, so that's how we size it. So we have all of these different choices. We can go with, we can go higher risk to reward, we can go the individual types of asset classes that we're trading, etc. Now, of course, we have two primary strategies where we put either a single classic fly out there, out of the money, and we usually use those in directional markets. And so that's one consideration. Or any other type of market that either non-directional or volatile market, we tend to put on what we call the Batman trade, which is two out of the money flies, one above the market, like a long call fly, and below the market, the long put fly. And so that gives us this sort of market agnostic situation there. Now, even there, we have to think about when we put on two flies, we're actually creating twice the risk. Say that 10 times fast. I dare you. When we put on two flies, we basically have double the debit that we're normally at. We might want to consider pushing those further out as an example. So again, there's another factor in the decisions that we have to make in terms of overall exposure. Now, we can point ourselves towards one end of the spectrum or the other based on some very basic things. So, for instance, how much volatility do we expect in the market? If it's a very volatile volatility regime, it's redundant. It's from the Department of Redundancy Department. Yes, a volatility regime, much like what we had in most of 2022, that often, first of all, demands that we take a market agnostic position. In other words, we put on the Batman trade above the market and below the market because we don't really know which way the market's going. And now we have to decide on the overall size of the trade. Now, if it's super volatile, that's good because that means earlier in the morning, we can put on a much wider trade, push it further out of the market because we can expect some range. And so that will result in real capital efficiency because we can put up very little money for very large potential rewards. As an example, an SPX trade that we could put on that's 40 wide and then put it out of the money by, say, a 1 to 20, it's only going to cost us $200 to put on a trade that can conceivably make as much as $3,800. That's cool. Really volatile market. We can have an exposure of only $200 for the potential of making $3,800. Now, can we expect to make $3,800? No, obviously not. But we still have that potential, and there's also a spectrum of profits that we can make between those. And when we go wider like that, that gives us a lot of great characteristics. I got an itchy nose. I don't know. What's going on here? Am I going to have a fight? We have this, when we can go wider and there's higher volatility, that gives us a lot more flexibility in our trades because we know wider flies tend to accelerate more quickly into their premium collection throughout the day, more so than the narrower flies. So earlier on in the day, in the trading day, in the early session, you can expect premium to explode very early and then continue that explosion throughout the day, as opposed to a narrow fly, which sometimes you have to wait until later in the day. So the narrow fly, even though it's less costly, has less opportunity to profit. So you might want to use that in a much less volatile environment. So you might want to create a Batman that's maybe 20 wide on either side and maybe just go to that 1 to 9 risk to reward ratio and get them really close together and hope that you're going to get a good price and then play that. Like today has been a really anemic day. I called it lukewarm, or is that what I called it? Lackluster, I think was the term I called it. And then there was somebody in the group that asked, how do we put some math, or how do we parse that? How do we determine what lackluster is, Ernie? Is there some sort of systematic way that we can re-engineer lackluster? No. And I'm not expecting everybody to look at my trades and say, oh, we must do what Ernie does because he knows everything. Because I don't know squat. I'm out there just like you trying to put on things that I think are appropriate for the condition. I'm also taking into consideration the market sentiment. i.e. the Federal Reserve, and what is their disposition? Are they going to be more accommodative or less accommodative? Are they going to be restrictive and tightening up their monetary policy, or are they going to switch to a different mood? And that's usually reflected in the trend that you see in the market. And all of that's going to play into the volatility and the cost of the trade and what I can expect for overall range of movement that day. Because if I expect much larger range of movement, then I'm willing to take way more risk or take a scaled down risk with much wider flies and push them further out with the potential of making much more or better use of my capital. Let's see. Other things that I would look at are things like overnight action in the Globex market. When the European, well, first we have the Asian market, then the European market are opening throughout the day. And I can look at those by looking at the futures market. And that will tell me a lot about what's potentially going to happen as the market opens. Not always, because between the European Open and the US market open, there's this big road bump called economic reports that usually come out between 8 o'clock and 9 o'clock in the morning that can have a substantial effect on either continuing whatever trend has been developed or reversing the trend that's been developed or squashing the trend that has been developed overnight. So that's another factor. You want to know what the overnight market's doing, what the bigger trend is doing, and then what the impact of an economic report might have on the market as the market opens. Wow, there's so many things that you have to consider. But what it really comes down to is how wide and how far out of the money do I want to put my fly? That's the ultimate choice. And all of those things that I talked about will directly influence how wide the fly is and how far out of the money that I want to put it. Now, the size can be calculated into that. So when I say calculated, it's all up here, right? I just make a mental estimation, a swag, a scientific wild ass guess. That's what a swag is. That doesn't mean that it's just a guess that I pull out of my ass. No, it is something that is born out of experience and also some math that I've maybe previously done or studies that I've done and understanding of how the market works. And so I have a general idea of what will work or what won't work and what has a better chance of working. So if I think there's going to be a super volatile market, I get amped up because I want to put on something super wide and way out of the money because I can use a small amount of money to potentially make huge profits. As a matter of fact, those have been my absolute best trades. One of the best trades I've ever had was a NASDAQ trade I made recently. It cost me $200 to get in. I made it 50 wide. It got somewhat into the market, and I made like close to $3,000 off of a $200 bet. That is insane. And I put it out there, even though the expected move said something like, oh, the market's only going to move 30, 40 points, something ridiculous like that, and ended up moving 100 points. Right? That's why you cannot pay attention to the expected move. The expected move is really based on statistical averages and standard deviation. And it is also based on what the current market is priced in, but that doesn't tell you what could potentially happen because there are so many other things that can affect that potential that the expected move simply does not cover. How often do you see price come right in at the expected move? It does occasionally, but quite frankly, rarely does it hit the expected move. And particularly in the markets that we've seen lately, it's either way above it or way below it, usually way above it. So the expected move is not going to be your friend here. We do not live by averages alone. As a matter of fact, if you live by averages, you will become a mediocre person, and mediocre persons are failures. And if you want to be a failure, then use the expected move to determine where you're going to place your fly. It's as simple as that. So I don't know if we have any questions in the peanut gallery there in the comment booth, but if you like this content, give it a thumbs up right now. Love to hear it. This particular episode, you should be able to go back to it, refer to it, take notes, take the transcript of it, pump it into ChatGPT, dissect it. As a matter of fact, I'm going to do that and then take that transcript and then write the notes and put them back into the description for you later on. All right. That pretty much answers that question. The exposure to the market. It's really It's not something that you come to each day and say, hey, I need to figure this out. If I don't figure this out, I'm going to fail. It's not like that at all. We have 5 opportunities every week to make a trade. In fact, you could probably get even more opportunities than that if you decided to break the day up into whatever time frames that you want to concentrate different strategies on. You could conceivably have 10 or 15 different strategies every week, 10 to 15 different opportunities to profit. And within each one of those, you could practice different ideas. And so then at the end of that day, you want to record what the market gave you and what you were expecting, and then be able to rate it, and then do that on every single trade. At the end of the week, you can then look back at that and see what kind of correlation there was to the choices that you made, the swag that you made. And then from that, you're going to develop over time an incredible amount of data. That data is going to be your guide on how you're going to make future decisions. And so that's how you learn. We don't know what we're going to do every day. Every day is more or less unique. Sure, there are some similar days and like days, but how many times have you said, man, that's never happened before? You say that all the time. So you have to expect that every day is going to be a little bit different. And so there is no one answer for everything. And there is no one way to look at it and say, I'm going to give you the definitive answer for position sizing today. For this market, it is X. And for this market, it's X.725. You just don't know that. Nobody knows that. So you make your best swag. You record why you made that decision, put it in your log, in your journal, and then you review that at the end of the week. You say, I was a dumbass here, but I was pretty smart here. I need to fix this, or there was something else going on here in this trade that had nothing to do with my choice. I got to get to the underlying cause for that and figure it out, because I've seen that happen like 5 or 6 times in the past month, and it's killing me. And that's where you find out patterns of behavior, good, bad, and try to perpetuate the good behavior. Try to fix the bad behavior by finding the root cause and then putting some sort of new habit-building routine into place. So none of this stuff is like you come into the market and say, I know exactly what to do. Because if you do, then I'm telling you, you're going to lose, because that means that you want to be right and you're sort of beholden to being right. And so you're attached to that idea. And if you are, then, well, how often have you been right? That's the thing. You can play the market with strategies where you do not have to be right. You just play it as if you have no idea. That's what asymmetry is all about. Taking small risks with a wide, big net. And then if the market does decide to give you something, then all you have to do then is be good at taking the profit. Take it when it's going to give it to you. So there you go. All right, we got a question here. Steven says, hi, Ernie, long time. Like the Terminator, I am back for a profitable ride. Go wide. That's exactly right. Wide is best. Beta Ada, that's a cool name, is an at-the-money straddle price useful for estimating movement or just BS? It's somewhat useful, but that's essentially what the expected move is. And it just simply doesn't always work out that way. I mean, you can use it for estimation if you want, but it's not going to tell you the myriad of other factors that can come into the market for eventually where price is going to go. So the answer is it's pretty much the same thing. The at-the-money straddle is in effect what the market is pricing in as its standard deviation, right? But really, how often do you hit that mark? Very rarely. Very rarely. So you have to make your best guesstimate. And besides, we're not looking to hit a mark. See, that's the fundamental mistake that everyone's making. They think that, okay, I'm going to have at the money or the expected move, and I'm going to put my center strike right there, and then that's what I'm going for. I'm going for the pin. It's just not going to happen. It's unrealistic. You're putting all of your concentration on an unrealistic trade when there's all this other opportunity in between nothing and that ideal profit. That's what you should be concentrating on, taking what you can get. Whatever the market's willing to give you, that is what you're willing to take. You don't have the say in it. The market does. You are nothing but a humble trader that is going to cast your net and take whatever you can reel in. You just want to be good at creating that net, doing the casting, and doing the reeling in. That's what you want to be good at, right? And you shouldn't have any predisposed expectation on what's going to be in that net. There you go. There's how you determine your exposure, how to master your exposure to the market trading 0 DTE. It really means that you need to practice your overall trading process. You have to be skilled at the execution of your strategies that you put in. You have to be extremely skilled at logging and journaling and then reviewing them in your weekly retrospective so that you can get some quality information that you can use to continually improve what you're doing from week to week to week to week. That is how you become a consistently profitable, independent, pro-level trader. There you go. All right. That's about all I have to say. It is now almost 3:30. The market looks like it is favorable to the trade that I have on, so I need to go take what the market is willing to give me. Peace to you all. See you next time. And now it is time for the music.